everyone. Welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas. I am the co-host here alongside Mr. Stephen Thomas, chief economist and founder of Reports on Housing. Today, we will discuss the most recent news and statistics, economic uncertainty, the housing market in an election year, the latest Federal Reserve meeting, and so much more. But first, Stephen, can you explain why you are covering your mouth and what has been happening recently?
All right. I'm covering my mouth because I had skin cancer on the lip. Let's go back to the 1980s when I was laying out on my out by the pool out in our backyard as a kid, and I would just put baby oil all over or Tropicana oil all over my body everywhere, and because I didn't know any better. And yeah, that's what I did. And I carried that forward until I started seeing a dermatologist who said, you need to put on lots of sunscreen and wear hats and things like that. My wife's constantly been reminding me of it. I'm not perfect and I'm going to get a lot better, obviously, because yes, I had squamous, which is a type of skin cancer. So I had that removed, and I had a few other things removed, and this one was a bit painful this time. So if anybody remembers, I had a mark on my lip about a month ago, and I had to make 6 weeks ago. I had to schedule another appointment for a precise specialist that does something called moles. And what they do is they take pieces of it and they keep on taking more pieces of it until all the cancer cells are gone. And they know what they're doing. They're very, very precise so that your face remains intact when it's all said and done. So I got this done a couple days ago and didn't want to do any videos, and here I am. You gave me the option of doing this thing just audible. But you know what? I think this is a good lesson for everybody to wear sunscreen and wear hats. The sun is, of course, beating down on us and supposed to be really hot this weekend. It's going to feel great, but make sure you wear your sunscreen. SPF 1000 if you can. Paint it all on. It's all good. They didn't have that when I was younger. So that's what's going on in my household. It's been busy. All the kids are out of school. And actually, our youngest, Zeke, is finishing Montessori. We dropped him off this morning for the first time, even though the kids have been off for, many weeks now. And it's his turn. He finishes kindergarten at a Montessori and goes off to first grade next year. So that's what's going on over here. Now I've got lots of kids, lots of interruptions. It's definitely the summer housing market. But Brennan, what is going on in your neck of the woods since Arsenal is on a pause?
Yeah, it's still pretty frustrating. I find myself just watching videos of people talking about it. I am waiting with so much anticipation for next year. I have so much hope, but recently I've been doing a little bit more decorating for my room, which is cool, and went to an Angels game, which is always fun. Maybe not the best team in the MLB, but I still have love for them, absolutely, and just been going around and living life and working a bunch. So it's been great. It's been an eventful couple of weeks, and I'm looking forward to the 4th of July and lots of stuff to come. So it should be pretty exciting. But Stephen, like usual, what is happening in the real estate world with supply, demand, and expected market time?
Yes, supply in all markets is continuing to increase. So we're seeing that normal summer pattern of the supply increases. It did last year, but it was increasing more on rising rates. This year, we don't have the rising rates, but we do have more homes coming on the market. So we have very, very similar demand to last year, and we have more homes coming on the market. So we're actually getting a decent rise in our inventory. And over the last couple of weeks, with the exception of Sacramento, we follow a whole bunch of different markets, but with the exception of Sacramento, we actually demand has gone down a little bit. And some of them are demands very similar to last a week ago, 2 weeks ago, and now but in most markets it's less. And when you have inventory that's rising and demand that's falling, which is atypical for a summer market, you get what we refer to as expected market times, the speed of the market. we see a much more noticeable change in expected market time than you do on days on market. Even though days on market's rising, it's rising at a clip of about a day to a couple days when you do averages each week. Or each couple week period of time, we're getting a bigger swing in the expected market time. Things are slowing down. We're seeing more open house signs. It's a bit more sluggish. You have to be very, very careful on pricing. The stuff that doesn't look good will sit. All the telltale signs of a normalization of a real estate market. We're not talking a buyer's market. We're talking where you have to be more precise, and sellers are not going to get away with overpricing or not doing what needs to be done to fix up a property. So that's where we're at right now.
We had a lot of action in the economy over the past couple of weeks. Could you give a summary as of today, which is Friday, June 21st, when we were recording?
Yeah, so last week was huge. We had the Fed met and we had CPI. And that fell on the same exact day. So I would argue that last Wednesday was one of the biggest movement days that we could possibly have. And the good news was CPI totally did everybody a big favor and came down more than expectations. And even though it came down more than expectations, now the Federal Reserve had an excuse to start to lower, but they did not do any lowering of the Fed funds rate. Instead, they opted to remain the same. And they also spoke and did a Q&A. What's most important in that day on Wednesday was them talking about where interest rates are going to go. And there are 19 voting members. So there's a bunch of Fed presidents as well as Jerome Powell, head of the Fed. They all get to vote. So there's 19 voting members, and 4 of them voted for no change at all for this year. And then big changes to come in 2025. 7 of them voted for what they said is 1 rate cut for the rest of this year. And there were 8 that said there would be 2 rate cuts later on this year. That's what they've placed as what they think needs to happen in order. So when you do all the averages, it came out to like 1 rate cut. But really, if you remove the 4 at the top, which I actually, in a lot of presentations, refer to them as knuckleheads, because when I actually hear them speak, they don't make sense. It doesn't make sense to me. This is all I do. I'm an economist. It makes me wonder, what is it they're trying to achieve? What is it that they're doing? Who are they listening to? Because it almost seems like they're listening to the wrong channels. It's like they're on the wrong channel completely. It doesn't make much sense. And I can see the argument between 1 and 2, which is where the real argument remains. And when you see the argument between the two rate cuts is actually winning. And it would just take a couple more CPI prints, one for the month of June that will come up next month, and then one for the month of July. And then we hit August. You know what? They actually don't move in August. They meet one more time. They meet every 6 weeks. Next time is July. Then after that, the next time they meet is not until the beginning of September. They skip August because that's that way that the 6 weeks works. So a lot of people are thinking September is when they're going to make that first rate cut. We felt that it needed to be a long time ago, and the longer they wait, the more damage it will cause. So, we listen to some really smart economists out there that I totally concur. They've got all the different degrees, have been spot on all along, and they firmly believe that if the Fed waits all the way till December, that they're going to cause more damage to the economy. It doesn't matter which administration is voted into office in November. They wait till December. That whatever administration it is going to have an issue come 2025. So the best thing for them to do is to go sooner rather than later. My vote is now. So July, it's not going to be July. So September is when they need to do it. And they could do one more rate cut in December. And that's looking like the direction most likely that it's going to go because of the CPI print and then the voting numbers that we saw. What see where everybody's headspace is at in the Q&A kind of leads us to believe that that's the direction they're going to go because they're very data dependent. They need to knock off this data dependency because we're actually moving on just about every single big data point. But because Wednesday was so big, it kind of muted some of the other data points that we received. CPI brought it way down, and the Fed met, and then it kind of like eased up a little bit. Still went down for the day, and we were underneath the 7% threshold because 10-year treasuries moved and mortgage-backed securities moved. So we had interest rates that were down below 7% for a few days. And then slowly, when you don't get a lot of news, it starts to like slowly bounce up a little bit higher as there's some profit takers. Then this week we had retail sales. Now retail sales came out and it also was less than expectations, and they revised the last 2 months down. And this release was for the month of May. They revised April down to negative. And they go back a couple. So then you go back to March, and March was also revised down. Now that's set. So what they do is they revise the numbers for 2 months. Now, April can be revised one more time going forward, and then it will be locked in. And we just got May. So they keep on adjusting it down lower, and it turned out that it was negative. And all of a sudden what we're seeing is a picture of retail sales not as robust. These are all painting the picture of everything that we saw with the different headwinds that we've been dealing with. So we're going in the direction of where the economy is cooling. It's not cratering. They need to make these cuts. And so it's illustrating, it's carving a path for them. They need to go. They've got enough data. They just want to make sure that they have even more data. The problem is if they wait for too much data, they'll have a lot that will make them move. And now they got to move faster and quicker, and different things can happen the longer they wait.
So, consumer sentiment in the month of June is currently down 5% compared to the previous month, so May, and up 2% in comparison to June of last year. So, on the contrary, we are seeing the stock market continuing to improve. So, I'm wondering, what does this mean for both consumers and retail sellers?
So the consumers, we're seeing some drag, and that's because they've run out of their excess stimulus package savings at the first quarter of this year. So that's gone. They're saving at a rate of 50% of what they did prior to COVID. And the last time we saved at this rate, personal savings across the United States, is at 2009 levels, not the best levels for savings. And then credit card debt is ballooning. And on that credit card debt, as they're accumulating, what they're doing is they have higher percentage interest rates, 22%. Then on top of it, you've got these automobile delinquencies, and credit card delinquencies are spiking at levels that we haven't seen since the start of the Great Recession, 2008. It doesn't mean we're going into a Great Recession. It's just all these headwinds that we're talking about is bleeding into what? Consumer sentiment, because they're not happy. They're pain. There's pain that's out there. And these aren't typically homeowners. These are people that may have purchased in the last couple of years and squeezed in, and they're still dealing with the high cost of everything. So recent purchasers could be part of this, but other than that, it's not really homeowners. It's renters from middle class on down that have been dealing with these rents that have been rising, and all these costs that have been rising, and running out of savings and everything else, and putting things on plastic that can only go so far until it starts to really slow down consumption. And that's what we're kind of seeing in retail sales. So this is where everything is starting to show that the overall United States economy is going to slow. And when it slows, we'll see inflation even get further in check. So everything that the Fed wants is definitely coming, because then the job market will follow suit. And it's like this domino effect. That's why keep these short-term rates higher for longer, and now you're going to cause even more damage, because if you start bringing down interest rates, even on that credit card debt, everything else we talked about, that can come down a little bit. So the longer they wait, the more stressed the system gets. That now they have to. There'll be some more lateral damage from that, collateral damage. So that's what we could possibly see. Down the road, that's where we're kind of at, and that's why sentiment's down.
So, when you were talking about the savings rate, like dating back to 2008 and the Great Recession, recently, I mean, all I can see is just so many comparisons to the Great Recession and so many different times and places. It's just insane. So what I'm wondering for you is, what would you say is a better comparison, if at all, that we're seeing any deflation whatsoever, or if it's a good comparison for today with the 1970s and 1980s economy?
Yeah, so there's so many different comparisons that are out there. It's definitely not the Great Recession. That's by far the simplest. We don't have I'm going to talk about stress that's in there. We don't have the stress of the homeowner. We don't have the silly financing that led up to the great financial crisis, and the backstop of all the subprime being picked up in these tranches of all of the mortgage-backed securities being put together and being sold off and being labeled as A paper, and they were really F grade. So, I mean, we don't have anything like the Great Recession. Now, there are some parallels to the 70s and 80s, and what the big deal is we had inflation. It was a much different variety kind of inflation that we had, that had been entrenched for a very long time, until Paul Volcker from the Fed came around and fixed things by jacking up the short-term rate. And the federal funds rate ballooned and made its way. They doubled the federal funds rate, and we saw interest rates for a short period of time that actually hit like 18%. So the average for the year was 13%, much higher than where we are today. But you can't even compare today to then, because we have higher dollar volumes and things like that, especially in housing. And even we're equally stressed as where we were in the 80s, yet we have interest rates that are only at 7%, half of where they were in the 80s. So the comparison is there, where we had these high rates, which the high rates is what we were dealing with in the housing market, and made everything very expensive, made it so that baby boomers, at the time the biggest first-time homebuyer demographic, first-time homebuyers that we had ever seen in the United States, they were all purchasing back then, and they had a hard time purchasing, just as millennials and Gen Z are having a hard time purchasing. That first-time homebuyer demographic that's really strong also is having a very, very hard time. So that's the comparison. But to think that inflation's going to come down and it's going to bounce off the bottom and go back up, there's really nowhere to draw that from. This is more pandemic related, not the kind of we went off the gold standard back in the day. That was part of the inflation. We also had a giant issue on the fuel side of things, where fuel was spiked and the reserves were way down, and we didn't have any gas, and you couldn't get gas if you had an odd number on your license plate. You went on Monday, Wednesday, Friday. And if you had an even, you went Tuesday, Thursday, Saturday. I mean, we don't have anything like that. So the comparisons aren't there. The only comparison is we were high on inflation and it came down. They're worried about the bounce. And that's why we had a lot of noise a couple months ago. In the month of April, we got March's CPI, and all of a sudden we saw a slight rise, and everybody was freaking out that this was the beginning of the rise. And the Fed's sitting back going, we want to make sure that this thing continues to go down. But the thing is I can't even believe that they're even making a stink about this, because the Fed doesn't really like this CPI. I mean, it's a good read on different things, but they know that the shelter component's broken. And on PCE, the Personal Consumption Expenditures Index, which is the better inflation gauge, is already down at 2.8, and it's going to make its way down further. It's going to take a while to get down to 2%, but 2% is arbitrary. It's something that they've been going after since 2012, that they made it official that they want to make it 2%, but they know that eventually they're going to get there. However, the longer they keep it up here, they're going to cause a lot of collateral damage, cause a big recession, and then we'll get down to that 2% real fast. On the backs of a lot of unemployment, a lot of pain, and it's just not the direction that you want to go. So that's the argument for why they need to go sooner, and they need to stop making the comparisons to these other decades, which we have no right making comparisons to, because it does not make sense.
So what I wanted to ask you, with the damage that could be done to the economy, is the Federal Reserve too late already to cut? And are we seeing any cracks or problems surfacing, would you say?
I've already mentioned the cracks that we've seen, the headwinds that we're seeing with personal savings rate, credit card debt, automobile delinquencies, and all that. That there's a lot of stress on the consumer. There's stress, and this is only going to add up over time. So the longer they wait, the more collateral damage. Is the Fed too late? My argument is they should have already gone. It would have made for that softer landing that they're after. They're lucky because a lot of these numbers are taking a while to make their way, but the longer they wait, the more collateral damage. They need to go in September. And if the longer they wait beyond September, it's our feeling that we're going to start to see more collateral damage. So that's to come. So not yet, but they better go soon.
So Apollo's chief economist came and said that the more the Fed insists that the next move in interest rates is a cut, the more financial conditions will ease, making it more difficult for the Fed to cut, and he calls it the Fed Cut Reflexivity Paradox. Can this explain as to why rates have maintained at an elevated rate over the past couple of months?
Yeah. So they want to, this is the argument that if they make these cuts, it's going to reignite the economy and things will go crazy. And then all of a sudden we'll be back to the same thing where we've got the economy going is going gangbusters again. And then we have inflation bouncing the wrong direction and other issues. Employment will be further up. But we're talking starting. We're talking a quarter point drop. And a quarter point drop is not going to make a massive move in how easy the financial conditions will get. It takes way more of a move. Remember, they went from 0 to 5.5. We're not talking 5.5 down to 1. We're talking 5.5 down to 5.25. So that's not a big move. And then we're talking about 5.25 down to 5. You still went from 0 to a 5 threshold. And that would be the argument is that it's already extremely tight. So just loosening it a little bit is not going to all of a sudden open up the floodgates of the economy because the consumer's already strapped. It's not going to make it so it's all super great where you go from a 20% interest rate to 18% interest rate on credit card debt. That's not going to do much, but it will do something, and it's moving in the right direction, and it will send great messages out there. And that is what needs to happen sooner rather than later.
So on a more positive note, the UK inflation falls to Bank of England's 2% target ahead of the election. How far would you say the US is from seeing this target being hit?
Everybody has their own inflation gauge. I would argue that you can't compare apples to apples and say our 2% inflation is their 2% inflation. That's not how it works. They have their own inflation gauge that they do, that these different countries have their own indices that they follow. And they're not relying on our consumer price index or our personal consumption expenditures index. They're relying on their own index, and they do that. And theirs is, according to them, at that 2% target. I can actually do it with the PCE and doing various manipulations show that we should already be at 2% inflation based upon, and I've heard some really, really smart people that this is what they do. They just follow nothing but inflation. Every time we get a big CPI or PCE print, I actually listen to Moody's Economics because they have a great podcast on it where they bring in some expert that knows the indices inside and out, and it's fun to listen to these economists talk. And you can make the argument that it's super easy to get there. They need to stop listening to it. It's going the right direction for sure. So we can't compare us to them because it's like apples and oranges when you're comparing these different indices that we're all tracking. So that's good for them and good for them because they've already made a change in their they're already making changes as far as their federal funds rate. We got to do the same.
So although we may eventually expect the housing market to return to normal with normal rates and hopefully fair pricing, but can we expect the housing market to favor first-time homebuyers at any point in the future? Would legislation have to be passed of some sort to see this happen?
Yeah, I'm not. Yes, there needs to be, it's not just legislation. Everybody needs to put on their big boy and big girl pants, get together and figure this out, and together, because this is not a party issue. This is an issue that we have with first time home buyers and the entry level housing that is not being built. And we're still not seeing a lot of it out there. What we're seeing when you actually dissect all the different markets of where we're getting more homes coming on the market, it's in the upper ranges. It's not the entry level ranges. Those entry level buyers that are purchasing or holding on to their assets, including all the people that are locked in these low rates, they're more reluctant to give up their low rates because they're fine. And why would they want to trade their low rates for something higher? So the only answer to this is to somehow, legislate legislates a different way of allowing builders to build without all the red tape. If you talk to builders, their biggest headache is all the red tape. The cost per unit that they have to put out there in order just to build. So what they're doing to answer that bell is building as much and as big and as expensive as possible that the market will bear, so that they'll make as much profit as possible, because that's who they answer to. They answer to the stock market, Wall Street, the financial market. So at the end of the day, that's what they want to do. They want to maximize their profits. In order to make it more a lot better for first-time home buyers and build that entry level, they need to get rid of a lot more of that red tape. There's plenty of it out there. They know that they can fix this by looking at the amount of red tape and the cost of just doing anything. A, and B, you do that first, and then you incentivize builders to build the entry level. Otherwise, they're just going to continue to go down the path they're going to go. Prior to the Great Recession, we were building all kinds of things, and we were building lots of it, and then they got burned. And now builders are very meticulous. They know how to maximize the dollar potential of every lot that's built upon. And so, and the answer to that is not entry level. So unfortunately, who's getting burned in this are first-time home buyers, because they're not building enough of the entry-level product. So that's what needs to be addressed down the road.
So, according to Clever Real Estate, a median home is unaffordable for the average American household in 44 out of the 50 largest United States metro areas and 46 of the 50 states. How much can this change once rates drop to a tameable level?
Yeah. The bottom line is my biggest fear is once rates drop, yes, we will get a much more affordable marketplace. What we picture is our interest rates making their way down to the lower sixes, and they will make their way down to the lower sixes. And there's a pathway for them to even come down even more as the spread between the 10-year and 30-year mortgage rates and everything is more certain, starts to squeeze. Now we're making our way to the low fives, because we're almost a percentage point higher than where we should be. So if we were down 6.25 and then it made its way and then the spread got better, it would go down to about 5.25. Our argument is actually, as the economy slows, that we can actually get into the upper fives. So let's call it 5.9999, and then the spread gets better. Now we're talking 4.999. An interest rate in the upper fours is much different than 7%, and how much it opens up potential buyers, the number of buyers, the number of consumers out there that can actually purchase a home opens up a lot. And as it does that, affordability levels improve dramatically. The only problem with that whole scenario that I just illustrated for you is, yes, we're going to get a lot more demand. And we will get more homes that come on the market, because the disparity between the difference between where today's prevailing rate is and where these homeowners have these locked, fixed in low mortgage rates will narrow, but it won't narrow down to enough where it's just going to open up the floodgates. It will open it up a lot more. So we'll get more demand than we do number of homes coming on the market. So what's that a recipe for? That's an imbalance that we kind of have seen before in 2020 through the first half of 2022. And we'll watch once again people bidding on properties, especially in the entry level areas, and now you've got values going up too quick.
So, as you've been a active real estate agent for many years, I'm sure it feels as if things were almost like yesterday. So, I was hoping to get your perspective on the Great Recession and how you combated that difficult time with so many others that I'm sure are listening as well.
Yeah, a lot of Tums. It's hard to stomach that market, but the best way to address these marketplaces is was to continue to go at it the way that it's it really boils down to being consistent and doing everything that you're supposed to do. On the real estate side of things, if you were representing buyers and sellers, it's building up your sphere of influence, it's calling people, it's knocking on doors, it's mailing to people over and over again. It's just this consistency of grinding. People that are grinders do well in any kind of a marketplace. Those are the people that up to the top, and people are going, how in the world are they still doing as many transactions? You were just mentioning to me an agent that you saw in a city where they had 9 listings, and this is California. In many states, you need 9 listings because the dollar amount's less. Now here, 9 listings is a sizable number of listings because they're sizable prices. So that's a lot. But I know who the agent is that you were referring to, and he's just a grinder. And there are plenty of grinders that are out there. And so those grinders, that's the cream that rises to the top. They're out busy, not licking their wounds and talking about how bad things are because, yeah, things are slow. We're doing way fewer units. The way to answer this is just to go out there and grind consistently on a day-to-day basis. It might not happen now, but the more you grind, the more it starts to appear. 3 months out now, in 3 months is now today. And now you're seeing that all of this starts to accumulate and you're out there just kicking butt, taking no prisoners. It's called grinding. And that's what people need to do consistently. It's kind of like the way we do our housing report. I've done it. I started this thing in 2004 by myself, just doing this thing, right? And every other week I was crunching the numbers consistently. There were only 2 reports that I missed, and that's because I actually had open heart surgery 15 years ago in May of 2009, and they took my laptop away and said, you're not doing anything. You're not doing those reports. That's the only time that I've missed since out of all these years, every 2 weeks doing, and consistency pays off. That's what this is all about. This is how we were able to grow the business the way we are. It's not all of a sudden we were here. It's that it took time to get here, and we did the same thing over and over again. And now I get to work with my son, and we have another guy that works with us, Matt. And then down the road, your sister's wants to work for us. So lots of fun. Your brother does some crunching of statistics. Hey, data, that's fun. That's what this is all about. So we're going to continue to grind, and I think that's what everybody should do.
So, final topic for today, I really do not want to bring up, but I feel like I sort of have to. Um, do elections affect real estate?
Who you elect can affect real estate down the road. And there will be a few people, and I hear this in all of my different talks. There will be a few people that'll say that I'm going to hold off and not list my house until after I hear what happens with the election. Let me tell you that they are the far exception. As far as where we see the data goes, the data does not prove out that the actual act of voting for somebody affects real estate. I can't see it in any data. I've never seen it before, but people will make an argument that it does, but it won't be backed up by any kind of statistical data. This is my lane. This is what I do. I've seen the data. I've seen the statistics. I don't see it bear out. So, you know what? There will be other economists that will talk about it. It's not their lane. They don't see the data and statistics consistently all over the United States like I have. I just don't see it. So it's not going to affect our election. So, it's not going to affect our election. It's not going to affect our real estate market, the act of actual casting a ballot.
Awesome. Well, thank you everyone again for tuning in to another episode of Let's Talk Housing. If you want to learn more about what's going on in the real estate world across Southern California, Bay Area, Phoenix, or even Vegas, feel free to check out our YouTube or subscribe today at reportsonhousing.com. Please leave us a good review. And if you have any questions at all, feel free to leave it in any of our social media platforms, or you can email me at info@reportsonhousing.com. And I'm happy to answer your questions on this podcast. So we will see you soon and have a fantastic rest of your day. Thank you.
Thank you, and wear your sunscreen.